Friends, good day! In this video I want to answer one question that I often asked in the comments. How to protect sold options. Today I will work with the strategy sold Strangle, as it is the most popular among traders, experienced and beginners alike. So let's imagine that right now the Bitcoin future price is 30,300. I have sold 1,000 put options at strike 28 and 1,000 call options at strike 33. When selling, the trader wants the price to stay under this cap, and then he will get all that sweet profit of the time premium of the sold options. But often the opposite happens, namely there is a price movement which can lead to significant loss. And here it is important to be actively involved in strategy management at the moment of price movement. How can this be done? There are two ways. The first one is to use delta hedging. If the price fell to the level of, for example, 28,000, something happened, the Securities Commission continues to go hard on the crypto industry and so on. Let's say it didn't happen now, but a week from now. In this case, we can use delta hedging. This is the easiest way to protect our sold options. In this strategy, the delta is positive 430, therefore we need to sell 430 futures. Which price should we choose? 28,000, the price after the fall. In the end, our structure is tilted. The call options are practically worthless, 47 points. But the price of the put options has risen, 1,098 points. The delta hedge makes our delta neutral and will keep it that way. And our strategy has turned into selling volatility. Our only hope is to drag this strategy to expiration, and that the price of delta hedging will be less than the premium of the sold options. But in doing so, we part with the idea of getting our cap, the initial profit. The potential profit has decreased, and it is unknown how much money will be required for the delta hedge. And this depends on the realized volatility. Okay, let's look at another way of protecting without a delta hedger. Sold options can be rolled. This should be done with call and put options. Put options of strike 28 need to be bought out first, and then sold at the next strike, i.e. 27. The same thing you need to do with call options of strike 33. Buy back and then sell. Let's say strike 30. But it depends on the cost. Now I'm going to do all the necessary calculations. So the put options of strike 28, 1,000 contracts, can be bought back for 1,098. That's the estimated option price in a week's time. Now we need to sell the put options of strike 28, 1,000 contracts for 678. This is the theoretical price in a week's time. I'm now greatly oversimplifying the demonstration. Initially, you need to calculate what the volatility will be and understand exactly what the price will be. And also be sure to control your margin requirements. And now we will work with call options of strike 33. The algorithm is the same. Buy back, you can see the price here, 47 points. Then we sell call options of strike 30. The cost is 377. Look at the result. Our Strangle was just rolled. The delta became neutral. We reduced it. The cap stayed almost at the same level, but got a little smaller. This is a pretty easy way of strategy management. A common question is when should you start doing these actions? I think it should be done when the option enters the money. You can do it a little bit earlier. I don't recommend doing it later. Don't forget that in order to reduce risk and margin requirements, if you see that a big price drop is possible and you don't have time to buy back the options, you can buy the next strike. To amplify the effect, you can additionally sell futures. Always be prepared to use delta hedging. So, if you liked the video, give it a like. Subscribe to the channel if you haven't already. Ask questions in the comments, I will be happy to answer them all. I wish you all the best and successful options trading.